So you're looking for a property deal analysis spreadsheet. Well, you've come to the right place. So what I would guess you kind of look for in a spreadsheet is something where it's clear where you input your input variables and the formulas are used to calculate your output variables. And then the data and the information is displayed in a very visually appealing way. But depending on which property strategy you're going for, you're going to want different inputs and outputs within the spreadsheet. So let's talk about strategies. There are a lot of strategies out there, but the main three being buy-to-let, HMO, and serviced accommodation. Then within those three, you can either buy them turnkey, so with not much work needed doing to them at all, pretty much ready to go, or the complete opposite, BRR. So you buy it and it needs a full refurbishment doing to it, with the aim then at the end of the refurbishment to refinance out as much money as possible back into your pocket. So that's 6 different strategies. Now, I looked at doing a spreadsheet to encapsulate all these strategies, but it gets too messy with the amount of if formulas and dead space from the factors that don't apply to the route that you want to go down. So, therefore, I have a spreadsheet for each. Now, the structure of the turnkey spreadsheets are slightly different from the BRR spreadsheets. There's a couple more things involved with the BRR ones. And so we're going to go through them now. Number 1, the refinance section. Seems pretty obvious. There's an additional section in the BRR spreadsheets to calculate the money left in the deal after you refinance. And then the return on investment is then calculated using that figure going forward in the analysis. Number 2, the finance method. In the BRR spreadsheets, you choose the finance method. So you select either cash, bridging, or mortgage. Now that's different from the turnkey spreadsheets that just assume you're purchasing with a mortgage, because cash and bridging really is most useful, and in 99% of times you are going to purchase with those when you're doing a lot of work to the property. Then number 3, the void period. Now the loss of rent from the void period is in both spreadsheets, but I've added an extra section in the BRR spreadsheets that mean you can input the council tax and the bills that you're going to pay while the property's being refurbished, because obviously that is a somewhat significant cost that needs to be taken into account when doing these calculations. Now, I did look at putting in a section where you then select which council tax band you're in, and then it calculates the council tax, but that's too complex because it's different for every council, and obviously I want this spreadsheet to be universally applicable, to the whole of the UK really, rather than just selecting the council that I'm part of, for example. So you've just got to input that yourself if you would like that in the calculations. So those are the differences, but before I show you them in action, let's take a look at what remains the same throughout all of the spreadsheets. So here we are in the Turnkey Buy-to-Let Analyzer. Now, as you can imagine, this is the most straightforward one. So let's start off with what is similar throughout all of them. So what remains the same is, if you've seen my previous video, you'll have seen a couple of these before. This is the refurb tab. Now, obviously, estimate with all your own costings, but this is a good place to price up the refurb. And then it totals it down at the bottom, and it pulls it into this cell here, into the initial cost output. Then we move on to the viewing tab. So I have curated a number of things that you need to look for when on a property viewing. And when you come back and you're doing your analysis, you could obviously just tick off one by one once you've done it. Or if it's not in a good state, for example, squeaky floorboards, you might choose to not tick it and then put some comments in about how squeaky the floorboards are. So next is the comparables tab. So like I said, you would input your links in there on the right hand side, whether that be Rightmove, Zoopla, whatever. Do your research and then some notes. So kind of speaking about, is this property similar in square footage? What's it sold for? When did it sell? So there's sections for recently sold, let agreed, properties currently for sale on the market, even though that's not the best gauge of what a property's worth. But in here, you will then obviously formulate your evidence for inputting things like the end value, the monthly rent that you're going to get, and so on. And finally, the notes section. So I like to put in the EPC certificate now. On the EPC certificate, it will give you the square footage of the property, so that's quite useful to comparing between different properties. Obviously, what the EPC rating is and how well insulated that's going to be. And then just a couple more links down here. So I use Street Check for the local statistics in the area, crime statistics, economic data, things like that. And then these two don't actually remain the same. So in this one, we've got schools and transport links, but in the serviced accommodation spreadsheet, for example, it will have things like your AirDNA link or screenshot as to what it estimates the nightly rate and the occupancy rate in the area to be. So it's just kind of location factors and other factors, anything you can just put in here that is going to help with the analysis. Right, let's get back to the main page. So here you've got space for the address. I like to link in, if the property's on the market, I've got a link in there to go straight to it. Then in these next sections, you can choose how many bedrooms, bathrooms, the property type. So bungalow, it kind of just outlines detail to do with the property. Kind of space to input there, whether it's freehold or leasehold. If you select freehold, then it will just come up as not applicable for the leasehold remaining. So obviously if it's leasehold, you want to know how many years you've got left on the lease. And finally, occupancy. So for example, this one actually has tenants in situ, but could be vacant, tenants moving out, owner occupied. Now, you may well be looking at an insane house with 11 bedrooms, let's say. And you've scrolled down, you've seen 10 is the most. And you're fuming. And you're thinking, Sam, this spreadsheet is useless. Well, actually, if you go to the tabs at the bottom, right click unhide, and it comes up with the hidden sheet that is mapping. Click OK, and then you can see that sheet here. So if you got any problems or want to add anything to this, then go into this sheet and just put in the data that you want in the drop downs. I'm just going to hide that again. And in terms of actually doing it, you would click into the cell, go to data, go to data validation, and then from there select the list of data points that you want. But this is not an Excel lesson, so we shall move swiftly on. Now, with Turnkey Buy-to-lets, this is the simplest of the spreadsheets. So you've got all your initial cost input, and you would input these figures here, cash flow input, and then at the bottom here, it's going to spit out all of these figures as they've all got formulas in. So it will use the numbers above to calculate these. Now, the stamp duty will be correct if your property is under a purchase price of 250,000, because after 250,000 in the UK, it goes up into the next band, so you will pay proportionately a bit more. Now, as I'm in the Northeast, it's kind of rare to get purchase a property over 250,000, as that, you would get not great returns because that can buy you quite a lot, right? But the stamp duty is going to be right up until that purchase price. Now let's jump over into the 1 year returns. And so all of these figures here are calculated. They're pulled in from this main sheet. It's pulling into here, and it kind of gives you a statement of, here's your cash invested. It totals up your rental income and holding costs for the year. And then your return on investment. So 10% here, 10.1% is a good return. And that is actually the figure that pulls in here into the front screen. Obviously, you can just change this to whatever you would like to be, because it's just pulling in from this number here. So you can actually see, if you bump the interest rate up to 5%, if you think, Sam, 4% interest rates, you can't really get that at the moment. Stick it to 5, and then you can see your first year return on investment changes to 7.8%. So next we have a section for the capital uplift in the property. So if I take you back to the front screen, we've got the purchase price to £100,000 and the end value is £100,000. So you've not made any profit there. So as this is a turnkey spreadsheet, it assumes you're not going to refinance out And any purchase of a property below market value that you're not refinancing, obviously your profit would just be in the equity in the property. So let's say you got this house for 85,000 and it's now 100,000. You would have to take account of the fact that you've just made £15,000 by purchasing it. So that would then go in to this section here, automatically pulls in. And then just below it, you got capital appreciation. So this is at 5%. Obviously you can change it to what you want, but long term it's 7.9%. So I feel like sticking in 5%, maybe for not the next year actually, for the 1 year returns, but definitely for the 20-year returns, I feel like it wouldn't be unreasonable to put 5% in. So this calculation is obviously quite simply, you've bought a house for 100 grand, 5% capital appreciation. It's now worth 105 grand, so you've made 5 grand profit. So the first ROI figure is a pure cash return. This is how much money have you actually got in your own pocket. Rather, this is kind of your total ROI once you've taken into account the increase in the property value. And finally, the profit from the rental increase, I've got in here to increase rents at 3% per year. And so obviously in the first year, that wouldn't be applicable. You wouldn't make any money because you'd wait a year before increasing the rents. So then it's the same for 5-year and the 20-year return tabs, but it's there to give you the perspective and the real long-term thinking of how good an investment is going to be. So if we scroll on the 5-year, we have obviously now after 5 years at 5% capital appreciation, it'll have gone up £27,000. And then also you see a nice little bit of profit from the rent increase as well. And then if you want to look at the 20-year returns, obviously the investment stays the same and then it annualizes your return on investment. So it will say you'll make £51,000 in profit from holding it over 20 years. That is obviously a return of 156%, but that's over 20 years. So that equates to 7.8% per year, which, as we know, as it's a turnkey, pretty straightforward. That is the same as the first year one because we're just doing the same thing year after year. That's in terms of a cash perspective. But then in here, then you get the real benefit of property, which in the long term, it goes up. So you're then gaining a lot more from capital appreciation than you have from the cash flow for it. And then you have this section here for profit from rental increases. So obviously increasing your rent 3% per year for 20 years then generates £5,877. And then so it gives you a total ROI per year of 33.9%. Right, so now we move on to the BRR buy-to-let spreadsheet and the differences I spoke about earlier. So as you can see in here, we've got a house that's, kind of seen better days, if we're being honest. Could do with some work, which is good. And let's say we're going to do a full refurbishment on it. Now, the first thing I mentioned was the refinance section. So if we go into the first year returns, obviously this will be the same throughout first year, 5 year and 20 years. So now there's this brand new refinance section in all its glory. So in our example, we bought this house for £90,000. We've then spent 18,000, although there's a 10% contingency in there. So it is pretty close to £20,000 there. And it's now worth, let's say, 135. Obviously, don't take these figures as gospel. Like, it's just an example to show you how the spreadsheet works. So in first year returns, we've got the end value of 135,000. The cash release is going to be 75% of that. We are going to assume here that you would be refinancing at a loan to value of 75%, which is very common. But you can always change it if you would like, as it's just in that formula bar there at the top. So this then brings me on to my next difference, which is the finance method. So in this cell here, you can select between cash, mortgage, or bridging. So let's just stick with cash for now. And as we can see, it then releases, we've then got the cash released value, and we don't have to pay off an old mortgage, and we don't have a bridging cost. So those stay as zero, and then it calculates your money left in as your cash invested, and then taking back the cash you released. So we've got 16 grand left in the deal. Now, let's say we want to change that and we take it to mortgage. It then updates this deposit percentage from 100 to 25%. Assumes you're going to put down the 25% deposit. So obviously you're taking it out at 90 grand. Sorry, the purchase price is 90 grand. So your initial mortgage is going to be £67,500. So after you've released that money, you then have to pay that mortgage off. And as you can see, that now comes into the calculation. And obviously your cash invested is lower because you've bought with a mortgage instead of with cash. So the deposit reflects that. And you've got the same amount of money left in at the end. However, when purchasing with a mortgage and then with the aim to refinance at the end, please be aware that in this calculation, it doesn't take into account any early redemption charges that you might have from paying off the old mortgage early. So if you would like, you could put it in the cash flow input. Or I would actually stick it in the mortgage broker fees. So if you've got mortgage and then usually mortgage broker fees, say 500. Let's say you know you're going to have to incur a cost of £1,500 from ending this mortgage early and refinancing. You would simply just stick to £2,000 in there. As I think quite a few lenders will charge you ERCs if you refinance within 6 months. That is kind of the rule. But don't, listen to your mortgage broker and all that. So now we can move on to bridging finance. So in this tab, select bridging and make sure the bridging cost percentage is right. So that's obviously your cost of borrowing, your interest rate, and that is per month. So then we come down to here. So obviously, as you can see, you've changed back to 100% deposit. It's then pulling in this that's how much money you're going to put into the deal. And obviously that includes your bridging finance. And so you're releasing the same amount of money. Pay off old mortgage is now zero. That's not applicable. But the bridging cost has now come into play. And it's calculated this figure based on you borrowing the purchase price, so £90,000, at a 1% per month interest rate for 8 weeks. Because you've got in here, refurb time in weeks is 8. Now, this may not totally be accurate because you've put the refurb time in weeks is going to be 8. That doesn't mean you just borrow the money for 8 weeks, because you need to do the refurb and then it could be another 4 weeks before you actually get the refinance money back out. By the time you've refinanced and actually got the money, it's another 4 weeks. So I would simply put in 12 weeks there. And also it's nice to kind of have a buffer, as refurbs always take longer than they're meant to, right? So then that figure will be a bit more accurate. And that is added to, because it's not an initial investment. It doesn't go into this bit here, but obviously it's part of the refinance. Then you would pay the interest once the actual initial loan's paid back. So that goes into your money left in. And then it's pretty similar to the rest, where you get your ROI based off that figure. And the final difference is in here, the council tax and bills during the void period. Just stuck in, for example, £400, and then that kind of drags into the rental income and holding costs. You've got the loss in rent from the void period. So that is, you are not receiving £750 a month for 12 weeks. So it obviously needs to take that into account, because at the moment the rent is just pulling in 12 times the monthly rent. And then below it, obviously you've got your £400 council tax and bills. So that's quite a useful section to have, I think. So now we move on to the Turnkey HMO analyzer. Now, the first thing to note with these HMO analyzers is it assumes 100% occupancy. Now, you might think that that's not totally accurate, that you're going to have people come and you're going to have months where maybe there's one person not living in a room. But I think it's not very far-fetched with the current economy the way it is and the demand for rooms. I think it's completely fine to have it as 100%. But obviously, you could just adjust the average rent per room to take account for that if you wanted to. The first feature with the HMO analyzers is the current bedrooms and the proposed bedrooms, and also the same with bathrooms. So even though this is a Turnkey HMO, that would still be useful. And then the rent is calculated by the average rent per room multiplied by the amount of proposed bedrooms. Pretty simple, really. Also, licensing fees are included because to operate a HMO, you need a license, and that just falls into your initial investment here. So then you've got here the cost of all your utilities, so your water, gas, electric, Wi-Fi, and council tax. This obviously assumes that you are running a professional HMO, so for people that aren't students, and it's going to be separate individuals that don't know each other beforehand, and the idea is that they obviously pay their rent and have all their bills included. Now, obviously, if you are renting to a group of students, if this is a student HMO, they would pay for their own bills. And so simply just put in this section here, just put 0 in each, really. And obviously with students, they're not liable to pay council tax. So that would also be 0. Now onto the BRR HMO spreadsheet. And obviously I've already explained the finance method. That stays consistent without. You've got the refinance section, all the same as the buy-to-let one before. Here you've got a little section for bricks and mortar or commercial valuation, just to kind of say which valuation you're going to go for. So if you didn't know, you can get a commercial valuation on HMOs if you meet certain requirements. I think it would have to be at least 6 bedrooms, 6 bathrooms. Basically, you've just got to prove to the valuer that you have significantly changed the use, and therefore the value of the property should be based on the rents that it can produce, which in most areas, I mean pretty much all areas in the Northeast, you are going to get a much higher valuation and able to pull more of your money out that way. If you want to know more on that, that is more for another video. But for now, let's move on to the next spreadsheet. So this is the turnkey service accommodation one. Now, I've used the same properties for examples in the pictures, the actual property that we've chosen here, but hopefully that doesn't confuse anything. So it's the same one in the Turnkey SA and HMO, and the BRR SA and HMO. But just listen along carefully and I'm sure it'll be fine. So as you can see, we've got some new fields here. So capacity, obviously it's not just anymore how many bedrooms we're interested in anymore, it's how many people can actually sleep. The target market, so here I've got city centre, holiday let, or for contractors. Now, as I explained before, you can go to the mapping tag and change those if you like, because there's likely to be more target market or a mix of some for you. And in this section, I just put managed or self-managed. And if obviously you're self-managing, what I would do here is put in the cleaning fee and put the management percentage to 0. But if it is managed, then you would assume that the cleaning fee is part of the management fee, and that's all paid for. So you would just stick in a management fee and then leave your cleaning as 0. And then you've kind of got all your bills that you're paying for as you would expect. So as well as those fields, what is also new is the nightly rate and the expected occupancy rate. So that's obviously what you would hope to achieve for renting the property for one night. And then how many nights, percentage-wise, do you think the property is going to be rented for? Now, if you're running a good SA, I think 70% would be a good target to aim for. Now, obviously, that is going to fluctuate throughout the year, but try and give an average for the year as a whole. Now, chances are you aren't having bookings coming to you direct. So you're going to advertise on a third-party website like Airbnb, Booking.com, or Vrbo. So what I've done here is, depending on what site you select, it then pulls in into the platform service charge the right percentage, depending on what percentage specifically they take. So Airbnb, you've got 3%, so they take a 3% fee. Booking.com, 15%, and Vrbo, not really even sure if anybody uses Vrbo, but I'm sure some people do, so it's there if you want, is 8%. You can see why people use Airbnb, right? 3%, and I think personally that's the most visually appealing site to use, so you can see why everyone uses that. And further down here, you've got the ROI at expected occupancy, and then ROI at 50% occupancy. So without you having to change the expected occupancy rate, you've just got to kind of test there to see what it's like at 50%. Now, this is useful because I think 50% is quite a good sense check of whether your property is breaking even at 50%. Really, if your property is just about breaking even at 50%, that is quite risky and I wouldn't go ahead with it. So you would like to be at least breaking even or comfortably breaking even at 50%. And then if you're hitting 70%, great. But it means if things do go bad and you're only hitting 50%, it means at least you're not losing money. Now, the first year returns. This page is the same as before, really, but obviously you've got quite a bigger rental income and holding costs, so you're paying for all the bills and everything. And the ROI figure, 24.1% in this example, and that pulls in back into the first screen there. As with the Turnkey spreadsheets, that is kind of what I tend to use. But the BRR ones, it will pull in how much money you got left in the deal. Now, for the eagle-eyed among you, you will realise that the first year ROI is 24.1%, but down below here it says ROI expecting occupancy is 25.2%. Now, why is that? Well, the first year ROI includes this. So in here, I've got a 1 week refurb. So it includes this 1 week in the year where you are not renting it out because you are furnishing it, setting it up, taking professional photos and getting it online. Technically not a refurb, but that's what it's in there for. It's a week for you to set up the property and get it online. So the 24.1%, we've taken account of that week that you're not receiving any rent for. Whether this 25.2% figure is kind of saying, as an ongoing rate, what return is your property producing? Now, that's quite a small difference, but obviously the difference between the two becomes quite apparent if you are doing a big refurbishment, which brings me nicely on to the next spreadsheet. Now, this is the big daddy of the spreadsheets. It's kind of got all the added extras in it. It's got everything you would need for, obviously, a BRR SA deal. Now, in this example, we've got us pulling most of our money out and we've got £12,000 left in the deal. Now, with quite a small amount left in the deal, especially considering how much rent you're going to get with this being a serviced accommodation, obviously it kind of distorts the ROI figure. Like 68% is very high. Even though that genuinely is the ROI figure, it just becomes less useful in terms of comparing between different projects. And perhaps maybe here, you would rather look at the monthly profit as a better metric. So if you wanted to, you could change this front panel just into a monthly profit by, let's do it now, clicking equals, and doing that divided by 12. So you can see £711 expected kind of monthly income. But we'll pull it back for now. So as you can see, kind of on an ongoing basis, with that just £12,000 left in the deal, it's doing 148%. But then in the first year, you are getting 68%. And that's, as I spoke about before, we've got in here 12 weeks. So we've got 12 weeks to do the refurbishment and furnish it and take professional photos and everything. Obviously, you're going to not be receiving any rent in that period. But the longer time horizon you look at, the more it's going to tend towards that 148%, because the more, as a proportion, the void period becomes smaller. So if you look at 5-year returns, now we're looking at an annualized ROI of 132%. And then in 20-year returns, we're looking at an annualized ROI of 144%. Makes sense, right? Well, that's all 6 analyzers covered in detail now. These spreadsheets are going to last you for the whole of your property journey. They're going to have it covered on all your main strategies. So now all that's left for you to do is to click the link in the description to get your spreadsheets. They kind of all come in one package, all 6 of them together. If you've got any questions or feedback or ways in which I could improve the spreadsheets, then I'd love to hear them. So please do leave a comment below. And finally, if you are looking to build a property portfolio in the Northeast, then please use the link in the description to book in a call with me and let's see if we can work together. With that being said, that's all from me. See you next time.